So, you're dreaming of financial freedom, right? Maybe you even want to retire early. But let's be real, the first huge hurdle is always building that initial chunk of capital, that first RP $200 million. How on earth are you supposed to get there when you're an employee just starting out? Well, let's break down the blueprint.
This is the big question, isn't it? For pretty much anyone with a regular salary, especially if it's just a bit above minimum wage, 200 million rupiah feels like climbing a mountain. You try to save what you can each month, but it feels like you're barely making a dent.
And here is the brutal, honest truth. If you somehow managed to save RP 1 million every single month without fail, it would take you 16 years to hit that target. And that's not even counting inflation. Which means in 16 years, that $200 million won't buy you nearly as much as it does today. The old way, it just doesn't work anymore.
This brings us right into our first section, and it's probably going to validate what a lot of you are feeling. Trying to just save your way to wealth on a small salary is pretty much an impossible dream. The math, you see, is stacked against you from the very beginning.
And this quote just hits the nail on the head. Look, saving is a fantastic habit, for sure, but it is not a wealth-building strategy on its own. To really move the needle, you need a totally different game plan. So why are the old rules failing us now more than ever?
Well, that leads us to the change in what you could call economic seasons. The entire financial climate has shifted, and using a strategy that was designed for sunny days, when you're in the middle of a storm, well, that's just a recipe for disaster.
You see, we've moved from what's called the snake era. That was a long period of peace, growth, and low inflation where, honestly, you could buy almost any stock and make money. But now we are in the eagle era. This new period is all about high inflation, conflict, and just pure volatility. The eagle preys on the snake, and those old, easy strategies, they get eaten alive.
And this is the most important takeaway here. Playing by the old rules is now incredibly dangerous. Just buying and holding a typical portfolio of stocks and bonds isn't going to cut it anymore. You need a strategy that's built for this new, chaotic world.
Okay, so if saving isn't enough, what's the first step? It's simple, but it's definitely not easy. Your number one focus has to be on aggressively increasing your income. It's the only way to generate enough capital to invest in a meaningful way.
And this really boils down to 3 concrete steps. First, you've got to master skills that the market is willing to pay a premium for. Second, find a job where your income isn't capped by the hours you work. And third, learn the language of money itself, investing and trading.
This part is so important. Don't waste your energy in a dying industry. I mean, just look at the difference here. While old sectors are flatlining, growing industries like green energy or AI are desperate for skilled people, and they're paying top dollar. A renewable energy engineer can pull in 12 to 25 million a month. That's where you need to be.
Next, you have to break out of that time for money trap. Think about it. Roles in sales or business development often have commissions, which tie your income to your results, not the hours you punch in. Same thing if you start a side business. The whole goal here is to unlock unlimited earning potential.
Okay, so once you've boosted your income and you actually have some capital to put to work, you need a really resilient investment plan. This brings us to something called the Dragon Portfolio. It's an all-weather strategy designed specifically to thrive in this volatile eagle era we've been talking about.
So here's a quick look at the overall breakdown. See how balanced it is? It's spread across 5 completely different types of assets. This isn't just about stocks and bonds. It's a really sophisticated mix that's designed to do well whether the economy is booming, crashing, inflating, or deflating. Let's break down each piece. First up, your stocks or equity. At 24%, they are still the main engine for growth in your portfolio. But, and this is a big but, in the Eagle era, you're not chasing those super speculative tech stocks. You want solid, cash-rich value companies that pay consistent dividends. That dividend income is like a lifeline when the market gets choppy. Next up, fixed income at 18%. This is basically the anchor of your portfolio. When stocks are going crazy and crashing, these assets, like bond funds, provide a steady, predictable stream of cash flow that keeps your whole ship stable in the storm.
And hey, stable doesn't have to mean low return. While putting your money in a bank deposit gets you next to nothing, some fixed income funds right now are offering returns upwards of 10 or even 11%. That is absolutely incredible for a defensive asset.
Now we need a hedge against inflation. That's where commodities come in, at 18%. This is crucial for the Eagle era. When the prices of things like energy and raw materials are soaring, the companies that produce them make huge profits.
By owning them, you protect your own purchasing power.
And at 19%, we have gold. Honestly, just think of this as the portfolio's ultimate insurance policy. If people start to lose faith in currencies like the rupiah or even the US dollar, gold is the one asset that has held its value for thousands of years. It's your protection against total systemic chaos.
And finally, we have the most unique part, long volatility, at 21%. Think of this as your offensive weapon. This part is all about actually profiting from chaos. For a regular person, this could mean setting aside a small, specific portion of your money for strategies that do well when the market makes huge swings, either up or down. Like trading very volatile assets or using special financial products that track market volatility. When things go crazy, this is the part of your portfolio designed to give you explosive returns.
All right, let's pull all these different pieces together. Here is the final, actionable blueprint that you can use as your guide.
Here's a simpler way to think about it. We can group our growth assets together. That's your value stocks and commodity stocks, which make up about 42%. Then you've got your stable anchor, the 18% in fixed income. And the final 40% is your chaos-proof bucket, split between your insurance, which is gold, and your high-opportunity aggressive assets.
But listen, before you jump in, you have to remember the rules of the game. This is a framework, not a prescription. You absolutely must do your own research. Tweak these percentages based on your own comfort with risk. And most importantly, always pay attention to the economic weather. The seasons can change.
And that really brings us to the end. The blueprint for navigating this crazy eagle era and building your first RP 200 million is all laid out. The only question left is the one right there on your screen. When are you going to start?